Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at Market Site, we have Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk. And Brian, as you and I have been talking over the past couple of weeks, September certainly living up to its reputation of being historically the most volatile month. And I mean, we saw it this week, especially on Tuesday with the CPI print. So it was really a remarkable move. We have not seen a flush like that in quite some time. I mean, down 5% on the day.
Yeah, and especially for a simple economic metric that comes out every month. It was the worst trading day. If you exclude March of 2020, which is certainly a unique period of time, it was the worst trading day in over 10 years for the Nasdaq 100 and other averages as well, not just the tech-heavy Nasdaq 100. So, pretty dramatic move. I'm not sure if it's because there's a lot of money on the sidelines and maybe the short-term trading is being driven by maybe quants and other kinds of shorter-term investors that have a greater than typical outsized weighting on the activity, but it's certainly a big move.
Yeah, it did seem very algo and machine driven for sure. And we're going to look at that in one moment, but let's just kick it off with fresh levels to watch on the Nasdaq 100.
Sure, absolutely. So here we're looking at the NDX on a daily period chart. And really, if we zoom in, just to highlight, this week's low, which is today, is testing the low from last week. So really short-term level that we're looking here. Nothing major here, but right now, 11,930 is the low that I would be looking to. It coincides with that 61.8 Fibonacci retracement that a lot of people out there are highlighting. And so if that breaks down below, then we potentially could be seeing a retest of the lows, which is down around the 11,000 level. So on the downside, that is the key level to look to. And then on the upside was just last week's high, very short-term level, 12,750. And then there's a gap a little bit higher from there, 13,200.
Yeah, and speaking of the velocity of the moves on Tuesday, and I feel like that's kind of been what this summer is about. Let's pull up your next chart here, taking a look at the Bollinger Bands, just to be able to put it in context.
Absolutely.
The velocity within the moves.
Yeah, so when we want to see, so the bands are interesting. We've shown two standard deviation moves. It's rare to see that for the index to get above and below that. And when we break that 20-day moving average, which is the midpoint of the bands, you can oftentimes see either key signals there or they can act as resistance support. And so on this recent downtrend that began in mid-April, was accelerated by Jackson Hole and then the CPI number this week, we can see any short-term rallies have been stalling at the midpoint of the band, which is the 20-day average. And then on the downside, we can see, particularly right after Jackson Hole, we've been riding the band lower. So we haven't this week, even though we had a dramatic sell-off 2 days ago from the CPI report, we haven't yet tested that lower band. If we do, that's around 11,666.
Yeah, and you know what I think is another interesting dynamic in the market is just the weighting that some of these tech heavyweights have, not only the Nasdaq 100, but in many of the indexes. When you think about it, Apple and Microsoft, especially with the Nasdaq 100, I mean, you're in the teens in terms of percent of how much they weigh to the up and downside in the index,
sure.
Right? So as goes Apple, as goes Microsoft, and a couple of the other heavyweights in the index, that really is what's driving the market narrative here.
Yeah, and that could be a good thing and that could be a bad thing. For the overall index, I would say particularly so for Apple because that's been such a strong relative outperformer. If you look at Apple over the NDX or Apple versus the S&P 500, it's trading right around all-time highs right there. That ratio, that relative strength ratio. So when most of the members within a certain index, whether it's the Nasdaq 100, the Russell 2000, large cap, small cap, if you have one member that is doing particularly well, that has a strong weighting in the index, it's going to actually benefit your performance.
Right.
And so
let's take a look at the chart because I think you have.
So Apple right now is 13, almost 14% of the Nasdaq 100. Microsoft is 10%. If we look at a broader index, the S&P 500, we can see this is the ETF for it. We can see Apple has about half that weighting, has about 7%. Microsoft is 5%. So particularly so with Apple, it has a much greater index weighting in the Nasdaq 100 index.
Yeah, I'm glad you showed the S&P 500, although we tried to talk about the Nasdaq 100 more because what's interesting when you see that even in the S&P that there are two tech names that are the top weightings in there, when you look at it more holistically from a sector perspective, and you have a chart on that here, you can see as the economy has evolved, how the weightings of energy and tech have moved inverse to each other. And I think that particular snapshot says so much about the market. I think it says so much about the economy. And to me, that's what I find interesting. If you look at 2007, I believe it is, they're nearly neck and neck in terms of weighting. And then as it moves out, it's just a huge dispersion.
Yeah, absolutely. So over time, when different sectors become in vogue, in favor, see better growth, more capitalization, they're going to have a greater weighting in an index. So looking here now at the S&P 500, we could see, the recent high for technology, which is the green line, peaked about 30% late last year in December of 21. Well, when we go back to the dot-com bubble of 2000, technology was 34%. So it was actually higher back then in 2000 than it is now. But relative to the energy sector, energy right now is up nearly 50% this year. It's the only sector that's in the green. The problem with that for investors that are have their investments spread out in ETF benchmarks that are tracking broad indices like the S&P is that energy is such a low weighting. Right now it's about 5%, a little just under that. So even though you have such a strong outperformance, if you're tracking the index, then it's not going to have as big an impact on the performance as, say, something like technology would.
All right, and to wrap up here, next couple weeks of the month, I think we'll still see some more of this chop because, again, we don't have earnings. We're really, we have the Fed next week. There's a lot of macro headlines.
Well, that's the big deal. You have the Fed next week. I don't think they're going to take their foot off the gas pedal. I don't think we're going to be hearing anything too dovish. Everyone, I think at this point, all year long, investors are, the anticipators are trying to anticipate what the anticipators are doing. So
right.
You want to get ahead of those who are trying to get ahead. And so really all year long, I think what we've been seeing is when is that dovish pivot? When is that dovish pivot really going to kick in? And I think when we saw that June rally off the lows into mid-August, that's why at Jackson Hole, Powell really, was aggressive there and said, both investors, consumers, and businesses, really consumers and businesses, will feel the pain of his tightening. So I think that was a signal there that the market should not try to get too far ahead and time in a dovish pivot.
Because I remember you and I were discussing in July, it felt like there was a policy shift when we saw that move off the June 2022 lows, and we couldn't really put our finger on it. It's not like earnings were that great that it warranted that kind of move. And on the flip side, the move that we saw on Tuesday off the CPI print when we saw that flush, again, I agree with you. I think if it's more algo driven than anything else, but this isn't a surprise to the market. For the Dow to be down 1,300 points, did no one not think that he's going to continue on his policy?
Well, I'm not sure if the messaging from the Fed has always been quite so clear. Remember in
right.
fourth quarter 2018, they were very aggressive, very hawkish, despite the fact that the markets were, selling off pretty aggressively there. And then in the July FOMC that you referenced, they did say they are now going forward will be data dependent. And so the read on that, I think, was that, okay, if inflation is about to be, turning lower or at least topping out, then they won't be as aggressive going forward. So maybe one more 75 bip hike and then 50 bips after that and then 25 after that. And then that was an incorrect read. And then as we saw, as the equities rallied, credit spreads tightened, the dollar even got a little weaker for a very brief period of time. We saw those financial condition indices, Goldman Sachs has one, there's a number of them out there. They started pulling back, showing the easing of financial conditions, which is the exact opposite of what the goals of the Fed are looking to see.
All right, fireworks for sure over the next couple of weeks. Thanks, Brian. Appreciate the insight as always.
No problem.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.